You are scrolling through a social trading leaderboard and spot a master trader with a 95% win rate. Their profit graph points straight up. It looks like guaranteed income, so you hit copy. For the first 2 weeks, the system works perfectly. Your balance grows by 10%. Then you check your app on a random Tuesday, and your entire account is at zero. The most frustrating part? You look at the master trader's profile, and they are still active. They survived the crash, that your capital was completely wiped out. This terminal interface shows the disconnect. On the left, the master's marketed ROI, an engineered rising line. On the right, the copier's reality, a volatile drop to zero. The failure happens because you're making decisions based on vanity metrics instead of institutional risk data. To survive social trading, you must stop acting like a passive follower. You need to evaluate these leaderboards exactly the way a quantitative auditor assesses a hedge fund. We will expose account-killing strategies, neutralize the execution traps, and mathematically engineer your risk parameters. Generating passive income through Forex requires trading the illusion of effortless wealth for rigorous upfront mathematical vetting. Let's start with the most prominent number on any leaderboard, total percentage gain. This number is engineered to trigger FOMO, and it masks catastrophic, mathematically unsustainable drawdowns. Auditors calculate the recovery factor, net profit divided by maximum drawdown. Trader A generates $5,000 profit with a $1,000 drawdown, scoring 5.0. Trader B made $10,000 profit, but suffered a $5,000 drawdown, scoring just 2.0. Trader A earns back losses faster. Auditors also check the profit factor, the metric showing exactly how much you earn for every dollar you lose. The institutional sweet spot is between 1.5 and 2.0. And a number consistently higher than 3.0 indicates a strategy manipulating data or avoiding serious market volatility. Prioritizing the recovery factor forces a difficult decision. You must actively reject the highest earning traders on the platform to secure long-term mathematical stability. There is a specific type of strategy that dominates social trading leaderboards, the martingale, or grid system. To an untrained eye, they look flawless. They boast win rates above 90% and display perfectly smooth, upward-sloping equity curves. Here's how they actually operate. The balance moves up because they double down on losing positions. But beneath that balance, the actual equity dives into a canyon. This gap is the floating drawdown trap. Open, bleeding trades have secretly consumed the account. You can spot this directly in their trade history. Check their time in trade. Holding losing positions for 3 weeks, while taking profits in 3 minutes, means they are running a trap. These no stop-loss strategies are guaranteed to fail. When a surprise central bank intervention or economic shock hits, the market moves sharply and never retraces. Bank for International Settlements data shows that during these events, market liquidity vanishes in seconds. There is no opportunity to exit, and the account goes to zero. You must trade the psychological comfort of a 98% win rate for traders who accept visible, controlled losses. A strategy without a hard stop-loss is a ticking time bomb.
Even with a safe strategy, you will encounter the performance gap. A master trader makes 5% in a month, but your account only registers a 2% gain. That missing money vanished into the slippage trap. This terminal map shows the literal milliseconds it takes for a signal to travel from the master to the platform and finally to your broker. By the time your order executes, the price has already moved. Add in broker spread markups, and the mathematical edge completely erodes. This makes copying high-frequency, 1-minute scalping strategies structurally unprofitable for followers. You have to calculate the minimum profitable pip threshold. If a strategy targets fewer than 3 pips per trade, execution costs will consume your profit margin. The second major mechanical failure is using a blind 1-to-1 copy ratio, ignoring the massive capital difference between your account and the master's. You must manually engineer a correct copy ratio. This breakdown shows why. If the master has $50,000 and risks 2%, that's $1,000. If you only have $5,000, you need a 0.10 multiplier, so your 2% risk is scaled to 100. You also have to check leverage discrepancies. If your broker restricts you to lower leverage, you will face a margin call long before the master trader. To defend against this, you need a circuit breaker. Set a hard equity stop. If your balance drops by a strict percentage, the system instantly cuts the connection and closes all trades. Setting a hard limit on maximum open trades provides another layer of defense, preventing a toxic grid system from quietly flooding your account with simultaneous losing positions. Relying entirely on a master trader to manage your downside is a critical error. You must engineer your own risk parameters and use raw spread platforms to protect your edge. There is one final retail myth to break. Copying 3 different euro-dollar trend followers is not diversification. You are just tripling your exposure to a single risk factor. The institutional solution is building a social hedge fund. This structural flowchart shows 3 distinct, uncorrelated strategies, combining a mean reversion scalper, a trend-following swing trader, and a fundamental breakout specialist. The mean reversion strategy is designed to capture consistent profits in quiet, ranging markets, like the Asian session. You pair that with a swing trader who captures massive economic shifts. When a major trend causes the scalper to take small losses, the swing trader is hitting peak performance, which smooths out your overall equity curve. If you are a burned beginner, stop chasing win rates today. Audit the floating drawdown of your copy traders and walk away from anyone lacking a visible, hard stop loss. If you are an optimizer looking to save time, stop reading price charts. Spend your hours managing copy ratios, running correlation matrices, and securing 0.0 pip spread accounts. Stop gambling your capital on leaderboards. Download the FXNX Master Trader Audit Checklist and run your top candidates through a risk-adjusted spreadsheet. True passive income in Forex isn't found by following a guru. It is meticulously engineered by adopting the rigor